Most people think America's greatest exports are technology, weapons, or culture. But the United States runs an industry far more profitable than oil, Silicon Valley, or Hollywood. An industry with no factories, no workers, no shipping containers. Yet it generates trillions in value and the world pays for it willingly. This industry doesn't appear in GDP charts or company earnings. It operates quietly, invisibly, and legally. It's called the dollar system. And once you see how it works, you realize the global economy is playing by rules most people never voted for and barely understand. Setting the stage, money as power. To understand the dollar system, we have to stop thinking about money as cash and start thinking about it as architecture. After World War II, the global economy needed rebuilding. Trust between nations was fragile, trade was chaotic. Currencies were unstable. Into this vacuum stepped the United States. With unmatched industrial strength and the world's largest gold reserves, America offered a deal. The dollar would become the center of global trade, and in return, the world would get stability. This was the Bretton Woods system. Currencies pegged to the dollar pegged to gold. And the U.S. positioned as the referee of global finance. It looked cooperative, but it quietly planted the seeds of dominance. Origins. When the dollar became infrastructure at first, the system was limited. Dollars flowed through trade, and gold acted as a constraint. But in 1971, something critical changed. The U.S. broke the dollar's link to gold. To many, this looked like weakness. In reality, it was the moment the dollar system became unstoppable. From that point on, the dollar was backed not by metal, but by global necessity. Oil contracts were priced in dollars. International debt was issued in dollars. Global banks cleared transactions in dollars. The dollar stopped being just a currency. It became financial plumbing. And whoever controls the plumbing controls the flow. The rise, how demand became permanent. As globalization accelerated, countries exporting goods accumulated massive dollar reserves. Those dollars needed a home. Enter use treasury bonds. Safe, liquid, and issued in unlimited supply, treasuries became the default storage unit for global savings. This created a feedback loop. Trade created dollars. Dollars needed assets. Assets funded U.S. deficits. Deficits created more dollars. America discovered something unprecedented. It could import real goods, cars, electronics, oil, and export paper claims in return. The cost of borrowing stayed low. Demand never disappeared. And the system reinforced itself. This wasn't luck. It was design. The breaking point, when scale became a risk, but every system breaks down when it grows too large. As U.S. debt ballooned into the tens of trillions, cracks began to form not in headlines, but in incentives. To keep the system stable, interest rates had to stay low. To keep rates low, central banks had to intervene. To intervene, money had to be created. The dollar system began feeding on itself. More debt required more dollars. More dollars required more buyers. More buyers required global dependence. At this scale, discipline became optional and confidence became everything. The fallout. Invisible costs, global consequences. The dollar system doesn't collapse loudly. It extracts value quietly. Inflation doesn't hit all countries equally. Dollar strength doesn't benefit all economies the same way. Emerging markets pay the price through currency volatility. Debt-heavy nations feel pressure through capital outflows. Sanctions become financial weapons. What looks like monetary policy inside the U.S. becomes economic shockwaves abroad. And yet, the system persists because opting out is worse. Selling dollars destabilizes currencies. Rejecting the system isolates trade. Alternatives lack scale and trust. The world keeps participating not because it's fair, but because it's functional. Failed fixes. Why replacing the dollar is so hard. Many challengers have tried. Gold-backed currencies failed due to rigidity. Regional currency blocks failed due to politics. Digital alternatives failed due to volatility and trust. Every replacement runs into the same obstacle: network effects. The dollar works because everyone else uses it. Breaking that loop would require coordination at a scale history has never seen during a time of rising geopolitical tension. So reforms stall. Diversification moves slowly, and the core system remains intact. Not because it's perfect, but because it's entrenched. Modern parallels. Empires and currency cycles. History offers a warning. When empires dominate trade, their currency dominates finance. When confidence fades, The decline is gradual, not sudden. Britain's pound didn't collapse overnight. It faded as costs rose and alternatives emerged. The dollar faces the same long-term question. Not will it fail tomorrow? But how long can invisible privilege outpace visible strain? The answer isn't dramatic, but it is consequential. 3 key takeaways. First, the dollar system is America's most profitable industry because it turns global trust into economic leverage. Second, the system survives not through force but through dependence. Most participants stay because leaving is more expensive. Third, currency dominance doesn't end with collapse. It ends with slow erosion until one day the system looks very different than before. Final thought, the most powerful systems are not the ones people notice. They're the ones people stop questioning. The dollar system doesn't demand attention. It demands participation. And as long as the world keeps paying into it, the industry remains invisible and extraordinarily profitable. If you want more deep dives into the hidden mechanics of global power, money, and economic control, subscribe to the channel. Because the future won't be decided by headlines, it will be decided by systems working quietly in the background.